given the euphoria we've seen, the disappointment will be equally dramatic. That just as everyone was so convinced that the economy and the markets were invincible, the realization that it's not will lead to some kind of fairly spectacular implosion in stocks.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As we prepare to enter a new year, there's a revived optimism on Wall Street. Excited in part by the pro-business policies of the incoming Trump administration, stocks are back to trading at record highs and investor and business confidence is rising. But that said, the average American household is still struggling under a high cost of living and a labor market that doesn't seem as robust as we've been told. So, how will this dichotomy resolve in 2025? Will consumers eventually catch Wall Street's optimism, or may stocks have to moderate their expectations for economic growth and corporate profits going forward? For an expert view, we're lucky to talk today with Stephanie Pomboy, economic and market analyst and proprietor of macromavens.com. Stephanie, thanks so much for joining us today.
Thanks for having me, Adam. It's always great to be with you.
It's such a pleasure, Stephanie. And happy holidays to you. You look festive as always.
This is as festive as it gets for me. But
Oh,
it's
it's
actually,
wonderful.
I'm in a turtleneck in Florida. It's cool enough here that I can be doing that. So it almost feels a little bit like Christmas around here.
All right. Well, look, I'm out in California. You and I both grew up in the Northeast, so we're used to, real snowy Christmases. But
Yeah.
like we moved to warmer climes. Right before I sat down here to join you on camera, I walked outside for a second. I could see my breath. I'm like, wait a minute, I'm not paying this
Wow.
ridiculous tax out here in California for the weather to see my breath, but so
Oh.
it goes. So anyways, I'm envious of your warmer weather there in Florida.
Well, actually, it's for us, it's cool. It's, 70 some odd, it's in the low 70s. So I'm actually enjoying it. I get to make use of some of the sweaters that I have from the days when we were toughing it out on the east, Northeast. So,
Toughing it out in the Northeast. I can hear though, if I strain really hard, maybe most of the viewers here playing the tiniest violins they can find as
right.
they're sitting there under these cold snaps and in some cases under feet of
Oh,
snow.
yeah.
All right. Well, look, a lot to talk to you about. You've written some fantastic recent pieces there at Macro Maven, Stephanie, I want to get into with you. But let's kick it off if we can with a general question I like to start these discussions off with. What's your current assessment of the global economy and financial markets?
Well, you sort of triggered one thing I wanted to mention right off the bat in your preamble here, where you referred to the labor market not being as strong as
Hmm.
it appears on the surface. And we're just coming off of another payroll employment report that surprised on the upside yet again. And yet, the household survey continues to send a totally different signal. In fact,
Yep.
this last month, the payroll number was up to 27. The household survey declined even more, down 355. But I went back and looked at what's happened over the last 12 months because we've seen this divergence going for a while.
Hmm.
Over the last 12 months, the payroll survey shows an increase in jobs of 2.3 million. The household survey shows a decline in jobs of 700,000. So you have a 3 million job disagreement between the household survey and the payroll survey. And at turning points in the economy, as you and I have talked about many times in prior conversations, the household survey tends to be the better indicator. So again, this divergence is not only ongoing and has, persisted for a while, but it's reached a magnitude we've never, ever seen before. That 3 million divergence we only saw for a nanosecond during COVID when the data on the wasn't able to keep up with the way things were shifting on this in reality. So that just by way of saying that in terms of my broad economic outlook or assessment of the economy, my sense is that we are or have been in recession. And almost every indicator that you look at suggests we're in recession, with the exception of real GDP. I mean, you could go through any number of things. Obviously, the household survey I just talked about, the drop in full-time employment, which is down over 1 million jobs. Whenever you're losing full-time jobs, you've generally been in a recession. When you look at things like consumer confidence and sentiment, they're bouncing back, but they are still at and, mired in really recession territory. There's so many indicators, real retail sales that have actually declined for 2 years now in terms of unit purchases. People aren't spending money because they want to. They're spending more money because they want to. They're paying more for the same items, or even less. And then things like the credit card delinquency rates, auto delinquency rates, corporate bankruptcy filings, all of those indicators suggest we're not just in recession, but we're in a severe recession. So again, it's almost everything you look at suggests the economy is really weak, with the exception of real GDP. And real GDP, to believe that number, you have to be willing to believe the government's imputation of what inflation is. Obviously, they're deflating it by, a 2% type of number. And I think most of us and most your audience probably would agree that inflation is running a lot hotter than that. And if you believe that, then you're talking about, even if it's running 3%, you're taking that GDP number down a lot. You're cutting it in half. So I went back and looked at nominal GDP, which includes both the real and the prices. And I think that's easier to measure. Think about, if you're running a business, you know how much money you have coming in. It's very easy to count how much money is in the register at the end of each day. And rather than, in this case, the government is basically counting units and then trying to impute some prices for each of those units. So nominal GDP is right on the cusp of a recession in terms of where it is right now. I know it sounds ridiculous to say, but at 5% nominal, we're actually on the cusp of what had been recession territory before. And if you look at the forthcoming estimates for where growth is going to go, most people see growth kind of decelerating a little bit over the next few quarters. Then we'll probably be in recession territory by that measure anyway. So this is all long-winded and kind of wonky way of saying, I think the economy presently is far weaker than people perceive it to be. And by people, I mean Wall Street and investors, not Main Street, who are living this reality. And that gets us into valuations and my outlook for the financial markets. I mean, you and I have been talking for longer than I care to admit about how extended valuations have been. And now we're in an environment where the anticipation of Trump 2.0 has basically mooted all of the negative data we're seeing, because people are saying, okay, yeah, that may look bad now, but on January 21st, we're going to flip a light switch and all of a sudden all this bad news is going to be in the rear view mirror. And, we need to buckle up because this economy is really going to take off. And I'll confess to having a weakness for that argument just because I'm still nursing the scars of 2016 when Trump won the first time. This was, people forget, but in 2015, we had one of the worst corporate credit cycles since the global financial crisis. It was really kind of a lagged fallout from the energy bubble bust in 2013-14 that followed the taper tantrum. But anyway, you had a real bloodbath basically in the corporate credit market, and they were laying people off. That's what companies do when they're struggling with debt service and their profits are underwater. The first thing they do is cut headcounts. So back in 2016, late 2015, early 2016, I was thinking we're headed for a recession. And I held on to that forecast even after Trump was elected, because I thought it's going to take him a while to implement these policies. And in the meantime, these oppressive interest rates are going to continue to exert a real tax on the corporate sector. And of course, he put through the corporate tax cuts and the deregulation, and the economy turned on a dime. So I get it. And I know why Wall Street is anticipating a repeat of that. But obviously, the backdrop today is markedly different from 2016. And the valuations I view as being the most conspicuous difference between now and then. particularly in the corporate credit side, where, now spreads are about as low as they have ever been in history. And back then, they were hitting new highs. So that, and obviously the stock market has tremendous amount of froth in it too. And there are any number of examples of that. Um, but so my sense is, loath as I am to bet against this economy doing a U-turn on Trump's pro-business policies, which I think will be hugely bullish in the long run. I think getting from here to there is going to be not nearly as seamless or easy as the markets are anticipating. Wow,
Okay.
that's
No,
that
it's
was a
good.
lot, Adam. I'm sorry.
It was a no. it was a great summary, and I'm so glad you got so many things on the table early because it makes me able to get to the more interesting questions faster here.
Okay.
Um, so one question that I've been asking a lot of people, and I'm going to ask you it here because you just kind of put your finger on it, which is, um, Trump's economic policies are they're pretty they're pretty disruptive, right? We want to gut the federal bureaucracy. We're going to take our tariff big stick and we're going to negotiate better trade deals for America. We're going to deport millions of illegal workers, millions of illegals, but many of whom are working in the real economy, just under the table in many cases. So if you can give him credit to say, you know what, let's assume he's successful in that stuff,
Mhm.
right? It probably will have a big impact, big positive long-term impact on the economy in the long run. The question is, can we get to that better destination without a lot of disruptive pain to the economy in the short term? And well, anyways, what's your general thinking on that?
Well, first and foremost, I think if you anticipate that the pro-growth policies are going to be stimulative to growth, and we're already in a situation where the inflation numbers are heating back up, you are talking about an environment where interest rates can be higher for longer. And that is a massive headwind to the economy broadly, but the corporate sector in particular. And, people can go back and listen to the myriad interviews you and I have done over the last year and a half, 2 years,
Lag
where I've
effect,
been,
lag effect, lag effect. Yeah.
right, my hair on fire about this corporate credit bust that was coming because of how levered the corporate sector has become and how much of that debt was rolling. And what's happened is basically since uh, 6 months into the Fed rate hike cycle, literally, October of 2022, they were basically halfway through the tightening. The market said, all right, now we're going to start to anticipate when the rate cuts are coming
Hmm.
because we've seen this show before. We know the Fed is going to capitulate and they'll reverse. And so the last half of the Fed tightening was completely ignored by the markets as they began to price in this pivot. And in so doing, the entire corporate sector basically um, structured its borrowing on the assumption
Hmm.
that rates were going to be lower a year or a year and a half from then. So flash forward, and now we're really taking a lot of the expected easing out of the market. And that's now before we start to see, in my view, the inflation numbers heat up even more. And then the markets will probably be a little panicked about, okay, well, that means, we're going to get less Fed easing. And what does that mean? They'll start to do the math on what it means for these corporations that are really struggling with debt service, who have been playing these kind of extend and pretend games and doing PIK issuance and this and that, just to get from here to there. So I think the number one thing that I would focus on is if you believe that Trump's going to be successful in getting these policies through, then you have to start thinking about what higher for longer means for your investments and what sectors are going to do well and which are going to suffer in that kind of environment. So I would say that's number one. The second thing is I kind of think of this a little bit like the EV mandates, where it's probably a really, I mean, I don't know, but let's just assume this is a worthy goal and that eventually we want to have an economy where production of critical things are here, is here in the
Mhm.
US rather than overseas. And that, we have energy is entirely here. All the pharmaceuticals are produced here. We have legal workers doing the work rather than their wages being pulled down by illegal immigrants who are getting paid, off the books at fractions of what people who, are citizens are being paid. Even if all those things are worthy goals, and I think they are, just like the EV mandates, you have to have that transition from here to there. You don't flip a light switch and say,
Right.
all right, tomorrow, everybody, who's illegal is gone and suddenly miraculously wages go up a lot and corporate profits, will be fine. No, I mean, this is the number one cost to business. So there are going to be dislocations. I think people may recognize that in the abstract, but it doesn't appear to me right now that the markets are being very discerning about how it's really going to flesh out. And then one final comment, and this is, probably not super worthwhile, but Doge, there's a tremendous amount of excitement, and I am among those people
Mhm.
about what might be accomplished in terms of just slashing the bureaucracy, because I think the regulations are really the thing that strangle entrepreneurial endeavors more than
Yep.
anything else. So I share the optimism and excitement about that. The thing is that when you think about the 3 million federal workers, I mean, just facetiously, I will say these people have spent their careers in Washington. They are eminently unqualified to do any kind of other work, right? Like, so let's just say, I mean, that's a little sarcastic, but what are these people going to do? So we're going to let's say we could cut out half of those people, 1.5 million people. What's going to happen is we're going to go from paying their salaries to subsidizing them via social supports, unemployment claims, whatever, until they're able to find some private sector employer who actually wants some bureaucrat shoveling who's done nothing but shuffle papers from their bathtubs, it turns out. There's a story about I forget where this guy was, EPA or something, who was, they're all working remotely. And this guy posted a video of him doing his work from the bathtub.
From the
So,
bathtub.
I mean, I don't know how many private employers can be really eager to grab onto this source of labor. So anyway, that's just a small and silly example, but it's just not going to be that easy to get a lot of this stuff done, to say nothing of the bigger budget cuts. Like, already the Republicans are saying, no, we want to increase military spending. So there's already resistance, and it's even within the ranks that should be, you would think, supportive.
Right, right. I've had some recent discussions with people about will Doge actually lead to a reduction in the deficit, or will it just be more sort of redirective?
Yeah.
Same amount of money is going to get spent, but all right, at least we're spending it more effectively, right? Who
Yeah.
knows, TBD. Neither you and I are political economists, but
Right.
wouldn't shock me if it were
Thank
somewhere in the
goodness.
middle. So a couple quick things. One, just to your point. So anyways, I take from your answer there that you're wishing the new administration well on these goals, but that you think that we're not going to get them for free. There's going to be some hard medicine that we're going to need to take to get to the better tomorrow. Um, One of the things, and again, nobody knows this truly, but in Trump in his first administration, very visibly sort of used the S&P as a benchmark. Hey, here I'm doing so great because look, the S&P is up, right? And he very well may do it again this time. Who knows? But I watched his interview yesterday with NBC, where it was the first real deep dive interview that he's given since winning the election. And they asked him a bunch of policy questions, and they were asking him about inflation. And they were saying, so will you guarantee that prices aren't going to rise for people? And Trump basically said, I'm not going to guarantee anything,
Yeah.
right? And he said, look, yeah, I'd like to bring them down, but it's not going to be easy. It's probably not going to happen overnight. And I wonder if this is a different mentality that he has coming in, right? First, he doesn't have to run for reelection.
Yeah.
Secondly, I think he's got a much clearer sense of what the agenda is, and hopefully a clearer, more real sense of what it is. And of course, it's Trump. He's always going to be a promoter, right? But I do wonder if he's not going to you know, maybe he's okay if the S&P goes down for a year or two, especially because as I've been predicting, he should he's got an incentive to let it, right? Because then
Yeah.
he's got a year or two that he can blame it all on the previous administration, and it
Yeah.
sets the bar low so that in years 3 and 4, if he does make progress, he'll look great.
Yeah, no, I absolutely agree with you. I think I thought it was notable that he's been quiet, not just in that interview, but over the last few months. Like in the lead up to the election, Scott Bessent, his new
Treasury
nominee
Secretary.
for the Treasury Secretary, had argued for basically the whole election cycle that the market was going up on the odds that Trump was going to win. So he really promulgated that argument. And I think Trump liked it. And that maybe that's
Mm-hmm.
one of the reasons why he became the nominee for the Treasury Secretary. But post-election, he's been silent on the market. It seems like he's really not pushed that narrative as much. And I would guess it's because he and the people around him see what you and I see, and that is this market is getting exceedingly frothy. And he doesn't want to be saying, hey, it's all because everyone's so excited about my election victory, and then watch it nosedive
Right.
40%, and be like, well, that's not me, So I think he's being shrewd about that, because I think, again, there's a very good chance that the market, maybe we get through this whole Santa Claus rally period and we turn the page and get into 2025 and people sit down after their holidays and cooler heads prevail and they say, actually, Adam and Stephanie were right. It's not going to be that easy to get all this stuff done. And maybe we should start to be a little bit more scrupulous about where we want to put our money and whether, all boats are going to rise in this environment. I think also the thing about the Fed was interesting. He kind of suggested that he wasn't going to replace Powell, even if Powell, I mean, I guess that was it. She said, if he's refusing to go. If you ask him to go, would you push? And he was like, basically said, I have no plans to try and get him to leave. Good till canceled would be my view on that.
Yeah.
But I think that's going to be another moving part because what the Fed does is going to be hugely influential to the markets here. Right now, it strikes me that they have really no ground to stand on for cutting rates in December. I mean, we just had a stronger payroll report, all of the inflation data, whether it's core PCE, CPI, PPI, the super core that they like, all of it is heating back up rather than continuing to decline. So they really are on quicksand with that. So I
All
think,
right. Although the market expects them to cut another 25
yes,
basis points. I'm
yeah.
looking right now at the CME tool, and it's 86% odds of 25 basis point.
I didn't say they wouldn't cut. I just said that the fundamental case for them to cut is
Yeah,
non-existent.
no, yeah, absolutely.
Those are two separate things.
Yeah. Um, so it's so interesting. So you talked about how the market basically for much of 2024 just kept pulling in the future value into today. Okay, the Fed's eventually going to cut rates, so let's start pricing that in now, right? And it did that all through much of 2024, hitting record highs all along the way, right? And then the market started saying, "Hey, we think Trump's going to win, and he's going to be pro-business friendly, so let's start bringing that in." So obviously, we're at these crazy levels of valuation now. In recent videos, I've been putting up the Euphoria meter, which there is such a thing, and it's a composition of several factors, including forward PEs and the VIX and a few other things. And that's at least it's got like 35 years of data in that data set, and we're now at the highest that we've ever been in that data set here, right? So it is, you can make an argument that Trump's inauguration might be a buy the rumor, sell the news event,
Yeah.
right? Where like it just can't get any better from here after this because we've just pulled all of tomorrow's prosperity into today, right? And to your point, maybe the Trump administration is aware of that, and so they're not going to be beating their chest about the markets, at least early on in the administration. We'll see. But one of the things you mentioned on the importance of higher for longer, right? If the Fed really is going to be more constrained in its ability to cut rates going forward, and so we're going to keep these, higher rates for longer. Everything you mentioned, I completely agree with. But one thing that you mentioned in your recent report, and I hadn't seen this number, and it really caught my attention, is so I interviewed Michael Howe not that long ago, and you're probably familiar with him. He's all about liquidity, right? And his calls on liquidity have been, at least apparently, very prescient, right? He's been right the past couple of years. When I had him on a few weeks ago, he said, "Look, my model still shows us in an upward cycle in global liquidity, but we're nearing its end. It will end at the end of 2025. And as you get closer to the end, the impulse decreases, just like throwing a ball up in the air, right? It slows as it hits its apex." And he said, so it's going to be less stimulative to supporting asset prices for that fact alone, right? But he said, what I'm really concerned about is this debt maturity wall that's coming up here. He said, yeah, we've been hearing about it for a while and everyone's kind of forgotten about it, but it's real and we're heading into it. And that's going to act like a big liquidity sponge. And he said, so that's going to make 2025 an increasingly rough year. And then, of course, 2026 will have the worst of both worlds. The liquidity cycle should have peaked and then start contracting, and we'll still have these debt refinancings, right? But your report here said that we should expect 10 trillion in
Yeah,
maturing marketable debt next year. That is an unbelievably big
I know.
number.
I couldn't believe it myself. So 6 trillion in bills, which really explains why the number's so big, because when you're borrowing on 3, 6, 9-month basis, you have to constantly, come back to the well, and 4 trillion in notes. Now, the scary thing is the note portion, just because those are longer dated obligations, which, it's not an issue in terms of having long dated obligations so much as what the yield was that those were issued at initially. So you're talking about notes that on average may be carrying yields around 2% that are going to have to roll at an environment where we're talking about anywhere between 4 and 5 and a quarter or so. So
And sorry, Steph, but just to clarify, so that 10 trillion, is that just government debt?
yeah, yes.
Oh, okay. So, all right. So,
That's
then
treasuries.
on top of that, obviously, then there's corporate debt, which is
Oh,
obviously re-rating at much higher rates,
oh,
right?
yeah,
Because,
yeah.
yeah.
Yes.
Okay. So,
But
all
that
right.
number, I'm guessing the corporate number is probably well beneath 1 trillion. I haven't looked at it in a little while, but I would guess it's probably more like 6 or 700 billion. I'd have to look at it.
Okay. Which is still not
it's-
pocket change. So we're essentially going to have the government, we're all familiar with the spike that we've seen in our service of the national debt.
right.
That's likely to get worse probably for this, what you're talking about here with this 10 trillion rolling over.
Exactly.
But in parallel, we're going to have the same thing happening on corporate balance sheets, right?
Yeah. And actually, where I thought you were going with it, since I thought you were talking about just the treasury portion, is the degree to which we may have a crowding out of the private sector, because the government is going to have to come up with $10 trillion worth of, money out there to refinance all this paper. So they're going to be competing with whatever it is, 700 billion or let's say 500 billion to 1 trillion on the corporate side. It's going to be, it's going to be interesting to see how all that plays out. But right now, the markets, again, if you look across the credit markets, you're looking at junk spreads that are about as thin as they have ever been in history. So there's really zero risk priced in there. Meanwhile, as I alluded to in my massive preamble at the top, Chapter 11 corporate bankruptcy filings are back to where they were, past COVID and in the global financial crisis. And they continue apace, not surprisingly, because rates aren't coming down, contrary to everyone's expectation. So, and it's obviously all the small and mid-sized companies that are driving those numbers up. We're not seeing a lot of high profile S&P 500 companies, but we are starting to see, names people know, like Big Lots, TGI Fridays, Red
Right.
Lobster, all of these things. So eventually we'll get to a name that captures people's attention. And I think it's just a matter of time. But, meanwhile, this presumption that the corporate sector can withstand higher for longer, I think is going to be tested, pretty aggressively in the new year.
So the Fed started cutting, yet bond yields are higher than they were when the Fed started cutting.
Yes.
Mortgage rates have gone back up, right?
Yeah.
Um, Bankruptcies have continued. I mean, everything that you just said, right? So why are credit spreads so tight? The
Yeah.
bond market's supposed to be the smart money, right? Why are credit spreads telling us that things have never been better?
Well, I think it gets back to what I said at the beginning, and that is that the perception of the current state of the economy is far more favorable than perhaps the reality. And also, even if you believe, as I do, that rates are going to be higher for longer and that that's going to require them to roll this debt at, more punitive levels, um, right now, the earnings expectation is providing offset, because if you think Trump's going to come in and cut corporate taxes and massively deregulate, you're talking about an environment in eventually that's going to be very bullish for corporate profits. The problem is, how long is eventually? And also, going back to my sort of more nuanced view of the corporate sector, you've got the S&P 500 or even just the Mag 7, and then you've
Hmm.
got everybody else.
Right.
Um, if you look at it, corporate tax cuts are great if you're paying taxes. But we have a huge swath of companies that are not profitable and aren't generating any income. They're not paying tax. So 40% or more of the small caps, the Russell, small cap index, is unprofitable. 40%. I mean, that's massive. I think 16% of the mid caps and somewhere around 6 or 7% of the S&P 500. So there are a lot of companies here who will reap zero benefit from a corporate tax cut because they're just not generating earnings. Now, hopefully, eventually, the economy picks up and their earnings do recover rather than them filing for bankruptcies. But when you're in an environment where you're talking about rates staying higher for longer, that's going to be a close contest,
Right.
So again, I think investors need to be very discerning about not looking at the corporate sector or, the market in general with one brush, because there's going to be it's going to be very different um, experience for different sectors and industries. And right now, I think the euphoria is just, hey, buy everything all day.
Right. So we're going to get in just a moment to your market outlook, but I assume you would be saying, hey, if you're looking for companies to invest in, really prioritize balance sheet health going forward here, because that's what's going to largely, separate the wheat from the chaff here as we stay in this higher for longer environment.
Yeah, 100%. And that might be harder to do than it
Yeah,
sounds.
then it sounds, yeah.
Uh,
Um, Okay. Gosh, where to go next on this? So we've got this situation where there's all these risks swirling around. Now I have seen recently that like the put call ratio is at like one of its greatest extremes, and so it's actually relatively cheap right now, relatively, to buy downside insurance. If you want to buy some puts on the S&P and whatnot, you're going to get a much better deal here than you normally get.
yeah.
Are you like actively looking at that and thinking that this might be a good time to load up on some insurance given your concerns and the fact that it's relatively affordable?
Yeah, I actually had every year bought puts, just a small position, because I felt like, I need to be vindicated. Yeah, I need to benefit from actually having what I've been saying come to fruition. I mean, I'd really kicked myself if the market went down 40% and I didn't have some short exposure. So each year I would just force myself to buy long dated puts. This year, I was like, no, I'm done with this game. Every year I light a match to, it's not a lot of money, but it's nevertheless, why am I lighting a match to this money? So to my great delight this year so far, I haven't missed any opportunities there. But I was thinking again on this idea, maybe I'm getting too cute, that we have this rally into the end of the year. And then, like you said, we come into January, maybe the 21st is the magic day, or maybe before, or, sometime after. But people start to actually think about how it's going to progress in terms of making these, implementing the policy and how long it's going to take to impact. At the same time, the Fed is kind of holding rates possibly higher for longer. So I am thinking about it. And then I got a tweet from a client of mine just a couple hours ago, that was a guy at Goldman Sachs, who I guess does their derivative stuff, who was pointing out that puts on the S&P are now the cheapest they've been. If you buy a 1 month out, 100% strike put, that's the cheapest it's been in over 30 years. So it kind of gets to your Euphoria index.
Hmm.
I'm sure it's pretty much the same chart. So yeah, I mean, the protection is cheap, relatively speaking. So, I'm definitely going to look into it. I probably won't put a whole lot of money on it just because I've been burned enough. And also I feel like, for me, and I know we'll get into, the details, gold, which is my core position, is a bet against the S&P. So I do
Hmm.
feel like if the S&P goes down a lot, gold may get hit initially, but it's going to recover quickly and move back up pretty sharply. So I feel like I'm fine with that. I'm still expressing the same view essentially, just not as overtly as I would if I bought the puts. But the
If
puts
you
look
bought the puts.
interesting.
Okay. All right. Well, look, I want to roll up our sleeves and get into kind of all right, so what are your expectations of the market, and then, positioning ideas coming out of that. Before we do, though, you and your partner in crime there, Grant Williams, are fresh off of a great event that you guys just held in Florida. You had some amazing talent there,
Yeah.
including Felix Zeloff, who I just interviewed earlier
Yes.
today. But yeah, he was just one of many like great minds like that you guys had there. So, are there any kind of key takeaways from that event that are worth discussing here?
Well, I think, there were a lot of interesting, very big picture ideas that talk about, what's the future of the nation state, for example. We're moving from this unipolar world to the
Right.
multipolar world. And so there were kind of big, almost philosophical, secular conversations, which don't really help investors who are trying to, come up with actionable ideas today. But obviously, people like Felix Zulauf were forthcoming with that kind of fodder.
Hmm.
We had Cy Jacobs, who runs a long short hedge fund that does just financials. And he had some interesting ideas there. But I thought, honestly, one of the more interesting conversations was with Peter Atwater. I think you've interviewed Peter as well. Have you on?
Several times,
Okay, yes.
having it been you who put him on my radar a few
Yeah,
years
I
ago.
thought that
Yeah.
you guys had he and I think people were very intrigued because a lot of people at the conference probably weren't familiar with him before they came to the conference. And obviously, he's going to sprain a finger tapping away on his keyboard these days, keeping track of the extremes in confidence. He's basically, for those who haven't watched your videos, but your interviews with him, he really is sort of a quasi behavioral economist, and he looks at sort of market mood more than anything, and or not
Mhm.
just market mood, but mood in the popular culture and the economy broadly. And so and this was a month ago now, was talking about things like, MicroStrategy and Michael Saylor and the Elon Musk, sort of these Superman characters that are emerging, and the idea that, you're going to reach an apogee here where these people who seem invincible suddenly crack.
Yeah. Suddenly
Um,
proved to be human. Yeah.
yes. And so, he said, again, I don't know when that's going to be, but you're getting to a point where the invincibility just cannot persist. So it was very much that sort of sentiment. Not surprisingly, a lot of the speakers sort of echoed that in their various disciplines and what they were seeing and doing. But it was a fun event, and Felix obviously, he kicked it off, and our whole uh, setup was the super terrific happy hour, which is taken from Seinfeld. So we had a Seinfeld set. It was the old Merv Griffin set from one of the episodes where Kramer gets the Merv Griffin set. So what was hilarious was the first, Felix Zulauf kicks this off, and we've got this glitzy red, shimmering curtain and all this tacky stuff and the big Merv Griffin set. And there's Felix Zulauf very seriously delivering his investment. So I loved that contrast. It was quite entertaining.
Wow. Well, I'll see if I can. Yeah, I know you guys shared a few photos. I'll see if I can find one of the set and put it up on the screen there when
Actually,
you're
we
talking about
did
it.
at the end of the conference, we did a live super terrific happy hour with all of the speakers, and that is available free. I can send you that video. It's 20-30 minutes or something, and it's kind of a recap with all of the speakers, and your audience can check that out.
Fantastic. So yeah, if you can do that, Steph, folks, I'll put that link in the description below this video so you can go watch it there.
Of course,
Thank you.
we'd love them to do the virtual pass and they can see all the detailed conversations, but that's a teaser. And if you, want more information, I'll send you the link to that as well.
Okay. Send me a link to that as well. And folks, I'll have those two links in the description below the video so you can go watch the free preview and then go buy the whole thing. Great. And then Steph, it sounds like it was so great. You guys are going to do that again next year. Is that the plan?
We're in discussions about it. We're trying to decide if we should do it, but the audience overwhelmingly wanted to do it. So I think it's probably going to happen, but we need to figure out the logistics and all that stuff.
All
But
right. Well, look, you'll be coming on plenty of times between now and then. If and when you get a date for that, just please share it with all of us.
absolutely.
Okay. All right. Well, look, in the remaining minutes we have left, let's get to the market side of things. What do I'm not going to ask you to pick a date or a percentage, but what sort of general arc do you think is most probable when you're looking at your set of possibilities for the markets next year? You're looking for does the party continue? Does the bloom finally come off the rose for all the reasons that we expected? Does something else happen? What do you think is the more likely scenario?
Well, I mean, I always have a flair for the dramatics, so I sort of don't imagine a slow grind lower. I imagine that given the euphoria we've seen, the disappointment will be equally dramatic. That just as everyone was so convinced that the economy and the markets were invincible, the realization that it's not will lead to some kind of fairly spectacular implosion. Yeah, I don't think you come off of this kind of a move in stocks just in a nice, gentle stair step lower. So whether that happens early on in 2025 or takes longer, but I think that's forthcoming. And then the question as to how long it lasts will depend entirely on the Federal Reserve's response
Reaction
to it.
function?
Yeah. And that will be interesting to see because in prior episodes, the Fed has barely waited a millisecond to come rushing in with the fire hoses. So we'll get some insight on just how much Powell and Trump really are symbiotic, let's say, when, what hits the fan and it falls to Chair Powell to try to figure out what to do about it. So I'm generally again negative on the outlook for the stock market. However, that said, as we talked about earlier, I take a flyer inputs on the S&P. I'm not going to stake my investment fortunes or my reputation on a call that the market's going to be cut in half, which would be less than what would be required to get it back to some reasonable valuations. Mostly because my bet again on gold does that for me. And if you go back and look, so far this year, now as of today, gold is back to outperforming the S&P. Obviously not including dividends, but in price, gold is back to outperforming the S&P year to date, and it's significantly outperforming the S&P on a year over year basis. So what I would argue we've seen isn't any fundamental increase in the, valuation of stocks. It's an inflation illusion that we've seen, and that's reflected by, when you deflate it relative to the only currency that really counts, gold, you're basically flat to down in the S&P. So people don't really look at it that way, but they should, because they're being, silently debased, is what gold is telling you.
All right. And in terms of gold, gold's had a nice tailwind at its back of late, which has been very welcome for us long-term gold holders. A big part of that has been, I mean, yes, the inflation that you just talked about, but also the fact that many central banks around the world have started to prefer purchasing gold versus treasuries. When you look forward, into the next year plus, do you expect that trend to maintain, grow, wane? What do you think?
Well, it's going to be really interesting. I'm sure you saw Trump's tweet about the BRICS and their dollar diversification efforts, and
Yep.
the idea that if they continue to do that, they'll be subject to 100% tariff. So that was a real shot across the bow, I think, to gold bulls, since that's what they've been running to when they've been diversifying out of dollars. But again, this is another one where, the reality is going to be a lot harder to accomplish than the tweet suggests. And, I would argue, and I wrote this up for my clients this week, that, you're dealing, where Trump in that tweet is dealing with the symptoms rather than the disease. If he wants them to stop diversifying out of the dollar, obviously he has to make the dollar that they're running from as good as the gold they're running to.
Yep.
And slapping them with 100% tariff does nothing to restore confidence in the dollar. Quite the contrary. I think it amplifies this notion of the US as a bully that helped ignite gold, in terms of, when we weaponized the dollar by freezing Russia's reserve assets, that really put the rest of the world on notice that, hey, they might do this to us, so we better quickly diversify and not hold all of our assets in dollars. So, this tariff threat just really amplifies that sort of weaponization. And I would think just strengthens the view on the part of these BRICS countries that they really do want to get out of the dollar. Now, maybe they'll be a little more quiet about it. China and Russia were out there every day talking about, well, we got to, get out of this dollar. We need to come, to some alternative arrangement. And we're kind of thumbing their nose at the Biden administration with all of this. Maybe now they'll be a little more quiet about it, but I don't think it's going to change the long-term shift. I'm not really sure that threat is going to have the desired result. The other tariff threats that he's made so far have already begun to generate the response he wanted.
Mm-hmm.
This one I think is going to be a little more tricky. But so I optimistically, now maybe that's me, seeing things through my gold colored glasses that imagines, the BRICS will continue. And frankly, they don't even need to create their own currency. They just continue doing what they're doing. And that will be enough for them in terms of diversifying out of dollars. They're just not recycling money back into our treasury market. I mean, China stopped buying treasuries a long time ago. Russia, obviously. So, they're now just finding other uses for these dollars. I don't know what's going to change about that.
Okay. All right. So what I heard you saying so far is, yeah, maybe buy a few S&P puts, don't go hog wild, but if you're thinking of buying them, now's not a bad time. Obviously, you're making a big case for gold. Earlier, you mentioned, if you want to be invested in equities in a time like this, focus on those with very healthy balance sheets that are less vulnerable to this higher for longer interest rate risk. Okay. bonds. Where do bonds fit in your outlook here? I would guess you might say, all right, T-bills probably good for those looking to be defensive. In the longer arc, where you see higher inflation, higher interest rates, that doesn't sound like a very bond positive market.
Yeah, no, but this gets tricky because in an environment where the Fed can't really push the Fed funds rate lever because of the higher inflation, if we get into a situation where the market goes down, obviously they would therefore have a little more maneuverability in that. But I don't know that, it's going to take a while for those inflation numbers really to come down. So they may not take the Fed funds rate to zero, but they might have to amp up their balance sheet to provide support for the markets and use that as a main tool rather than the Fed funds lever.
Mhm.
And in
So in that
that
case,
case,
they're buying long dated
exactly.
bonds. Yeah.
So in that case, then you get into the sort of Felix Zulauf school of forecasting where I've got to get the squiggles. So
Yeah.
first, you'd have an environment where rates were going up, and then when they expand the balance sheet, the top is in yields, and they start to come down as the Fed steps in as the buyer of last resort. But so it gets a little squishy. But I also think that it will become clear between now and then that the economy really isn't as strong as these headline numbers suggest. That said, I do describe it as more of a stagflationary backdrop where you'll have growth being weaker, inflation, not like taking off, but not going lower anymore. And we're already above the Fed's target. So you could have an environment where the curve inverts again. Um, so we'll see. But I would be more inclined to just be invested in, let's say, the 2-year section of the curve and just wait and see
Yeah.
what goes on with that.
Capture
Um,
your 4% and just watch with popcorn. Yeah.
exactly. Yeah.
All right. So for folks that are interested in what Felix Zulof's forecast for the squiggles are, you can watch the video that came out, should be 2 days before this one came out. That's where I interviewed Felix, and he goes through all that. And he does very much have a kind of up, down projection there. All right. So Steph, you talked about gold. Just how about hard assets in general? Commodities, real estate, et cetera. Um, and I mean, feel free to give me your long-term view on them if that's easier. But next year, what do you think? I mean, it seems like if interest rates aren't coming down any point in time soon, and the economy is not going to be growing materially stronger, we've
Real
got a housing
estate's not going
market
to be.
that's in tough
Yeah.
shape and probably only going to get worse. Um, Commodities, I don't know. I mean, I guess you would think demand for them would go down if the economies are slowing, but what do you think?
So I agree with you on the real estate thing. I think, again, it's going to come down to location, location, location. But generally, I think if you're going to talk about nationwide average experience, higher rates and a slower economy is not going to be good, and it's just going to perpetuate what we've seen so far. Um, I guess but there'll be pockets of like I'm thinking again, maybe this is through my rose-colored glasses, but with Trump over the bridge here in Mar-a-Lago and everyone who is in his orbit now buying places down here, that island is going to do pretty
Hmm.
well. But there'll be pockets here and there. But there's Nick Gurley, who you talk to, I know
Hmm.
on the regular, has done a lot of work on that, and shows some serious issues in Florida, especially related to the insurance problem, et cetera, and not to mention massive overbuilding. But just broadly, I think you're right. The higher interest rates will be a problem, and we need to see income growth move up enough to help neutralize that in terms of housing affordability. And again, that's going to take a little while. In terms of commodities and other hard assets, I actually would be bullish. I mean, obviously things like uh, you know, lumber, for example, maybe not so much, but
Hmm.
I think in the broad sweep of things, we're talking about an environment where people are shifting from, paper assets to hard assets. And that, to the extent you can stockpile things, China's going to be trying to use dollars. They are already, stockpiling oil and gold. Maybe they start stockpiling, copper. Obviously, they have minerals and all of this stuff. So I don't know that I'd be particularly negative on commodities in the broad sweep, but specifically not against paper assets. I mean, I would expect if you look at, a chart of like the S&P versus the CRB, which looks like, the S&P has gone like this. And I mean, basically the ratio is like this,
Right.
CRB has gone nowhere, that we're hitting a peak in that, and that you're going to see commodities outperform paper assets. And I would say related to that, another sort of shift that I think you're going to see on a secular basis is from the developed world to the emerging world, where developed world economies like the US, Europe, Japan, etc., are going to underperform emerging markets over the next several years. I just think that's part of this broad shift that we're seeing underway. And it's part of this retreat of globalization that I
Hmm.
think Trump's victory represents. And it's not just the US. I mean, we're seeing this all around the globe. This sort of shift to, hey, let's focus on what's happening here. Let's look at our domestic economy and our populace rather than letting all these immigrants in and having these open borders and trying to, kumbaya around the globe. It's everywhere now that you're seeing this. And I think that that generally, again, is much more favorable for tangible hard assets than it is for paper assets, and generally also will be better for emerging markets, which are unencumbered by the massive debt that the developed world is going to have to try to finance without access to everyone else's money anymore.
Got it. To totally get you there on commodities, I've got two voices in my head. The first one is Brent Johnson, who I just interviewed, and Brent's theory, which has played out really well. It's probably one of the most explanative theories that I've come across yet in years of doing this. Is the dollar milkshake theory. But as I was talking with him about it, you can also refer to it as like the world's capital comes to the US theory,
Hmm.
as America's got a lot of problems that we've been talking about here, but so does the rest of the world, and a lot of the rest of the world has way worse problems than we do, right? And right now, a lot of that capital has been coming to the US because we have been the best growing economy, and our markets have been performing really well. And to a certain extent, it's almost like a self-fulfilling prophecy. The markets
Yes.
do well, capital comes here, things go up, so people send more capital here. But if we expect some of these shoes to drop economically that you've talked about, likely it's going to hurt other places in the world first,
Hmm.
especially higher interest rates. And we've got the whole euro dollar market, right, which is underappreciated by most investors, but it basically means that, if cost of dollars goes up, it hurts way more elsewhere than it does inside this country. And so as those countries start to stagger, either economically or because their currencies are going down and it's harder for them to repay US debt, demand for dollars goes up. Rich people in those countries who are seeing their country struggle send their capital out here, right? So that could buoy things for a bit. Um, uh, so so that's one factor on one side saying, well, maybe don't sell America short. Maybe it actually is going to benefit from all this
Right.
stuff. Then I've got Grant's Williams' voice in my head where he said, look, emerging markets, developing markets have underperformed for so long, and they've gotten punished and punished and punished for it. And at some point, prices can go so low that you just have screaming deals.
Yeah.
And eventually, especially as things start to slow here in the US and developed market, investors may start waking up and saying, oh, wait a second, we've had a great ride, but I mean, there's just blood in the streets in these other countries now, and it's time to start, rotating into that. So I have no idea which way it's going to go, is what I'm saying, but I am hearing those two voices loudly in my
Yeah.
brain right now.
Yeah, and I mean, I obviously have a weakness for Grant's argument because, if you look at, again, I do everything in charts, but if you look at the emerging markets relative to developed markets, they're at record lows. So it's not even a question of, well, they're kind of cheap. I mean, they've never been cheaper,
Deeper,
or
yeah.
put differently, developed markets have never been more expensive than they are. And again, I come back to, I think about these big secular themes like the end of globalization, but it's an important, if you believe that we're kind of at the bookend of globalization that was first started, launched under Reagan in the early 80s, then you're talking about a total shift in the investment backdrop from everything investors have been used to for their entire careers.
Right.
Basically all of us who are investing right now, this is all we've ever known, is what I would describe as the great moderation, which is this kind of nirvana where interest rates and inflation have just steadily gone lower and lower and lower. So the cost of capital was lower. Money that was freed up from the economy by lower inflation was able to flow freely into financial markets. So you had this kind of decrease in the demands for money in the economy, even as the economy was growing, and this massive excess liquidity that was free suddenly to flow into financial assets. And this created a whole, basically, economy that is geared to the financial markets now. At the same time, in emerging economies, they're still there making real stuff, doing real things. And we're here basically shuffling paper around in the digital universe. Now, I'm obviously grossly oversimplifying this stuff, but at the end of the day, if you think we're at the end of globalization and everyone's going to turn inward and try to live off the fat of the land, as it were, in their own borders, that's going to require some real work here. Whereas in the EM, that's what they're doing. They're already living that world. We're going to have a massive adjustment here. So, and as relates to, the idea of their obligations in dollars and their difficulty in servicing dollar denominated debt as the dollar goes up. Well, that's true. But here again, you can't paint all these economies with one brush. In aggregate, the emerging markets are the net creditor nations to the rest of the world. So yes, there are certainly those economies that are massive debtors and have way too many of those debts denominated in dollars. But in aggregate, we're the debtors, they're the creditors. So I again come back to Grant on that side of the argument, but time will tell.
All right. One last question on something that, in all fairness, I don't think you consider yourself a huge expert in, but I know it's of interest to people. So, talking about Bitcoin.
Oh, good God.
And I know, and on one side, there are people saying, and let's forget the foundational arguments for it. But some saying, look, if you look at its correlations, it's like the most speculative asset out there, right? Like when capital flows are positive, when the market is risk on, Bitcoin does better than any other asset class. And so there's the concern that, hey, if we go through a market correction, Bitcoin will likely perform worse than almost everything else because that works in reverse. Then there's the other side of the equation, which says, no, it's store of value, and everybody's realizing that the fiat currencies are getting devalued, and all that side of things. So let me just ask, if what you think is going to come to pass comes to pass in 2025, will that be, do you think, favorable for the Bitcoins of the world, or less favorable?
Well, I definitely fall into the camp that views Bitcoin more as a speculative asset. I'm not talking about blockchain and the digital technology. I'm talking about the actual cryptocurrencies. And, I think when we've talked about this in the past, I'll start by confessing I'm a total Luddite. I like things I can touch and feel and understand. And that's why I'm in gold, not Bitcoin. I also, and this may sound really stupid, but I don't get the warm and fuzzies from the idea that all of my assets are only as good as my internet connection. Call me crazy, but
Or your ability to remember your passkey. Yeah.
right. Okay. Absolutely. And I guess there are plenty of people who have forgotten those. And then your money is totally, somewhere in the stratosphere that you can't reach. So none of that really inures me to it. So I'll just start with that confessional. but you know, I guess this is one where I would have said all of this stuff at 10,000 and did,
Right.
and here we are. So phooey on me. I should have bought a little and just enjoyed the ride. But again, who was it who said over time everything reverts to its intrinsic value?
Mhm.
In the case of Bitcoin, my opinion is that value is zero. I mean, it's just computer code as far as I can tell. And I would rather own what's proven to be a currency for centuries and take comfort in that. I would say if you're buying Bitcoin because you view it as a hedge against the debasement of the dollar and fiat money in general, um, you'd be better off in gold because gold actually trades that way and Bitcoin trades more like a speculative asset. If and when it starts to trade like gold, that'll be a different story, but that isn't where it is right now. If you're buying Bitcoin on, for pure speculation, knock yourself out. I mean, good for you. You're probably crushing it. So that would be my view on Bitcoin. And now you can cue the hate mail.
No, I was going to jump in and just say, for the Bitcoin faithful, Stephanie answered a question I asked her. She gave her honest answer. Please
Yeah.
don't beat her up if you have a differences of opinion are what makes a market. All right. Well, look, Stephanie, I mean, I could always go on hours with you, but we're going to have to begin to wrap this up. Very important question. For folks that really enjoy your appearances on this channel and would like to follow you and your work in between those appearances, where should they go?
Well, you can follow me on Twitter at @spomboy, although I'm not a frequent tweeter or Xer or whatever we're calling it these days. But you can always go to macromavens.com and you can learn how to subscribe. And if you do the retail thing, you also get the podcast that I do with Grant Williams, the super terrific happy hour stuff, and whatever other things I do here and there. So that would be one way to do it.
All right. Well, look, Stephanie, when I edit this, I will clearly put the links to your X account and your website up there on the screen. But folks, if it's not abundantly clear, I'm a tremendous, tremendous fan of Stephanie and highly recommend that you certainly follow her, but also if you have even just the mildest of interest, go follow her Macro Mavens work and do everything you can to follow this great woman. All right. Well, look, Stephanie, stay here real quick. I want to give you the last word. I just have like 30 seconds of housekeeping. Folks, if you've enjoyed having Stephanie on this channel, would like to thank her for being so gracious and so eloquent and sharing so much of how she sees the world and really giving us lots of great actionable ideas to consider. Please do that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you would like some help in figuring out how to navigate the road ahead, especially if it starts to play out the way in which Stephanie thinks it might, highly recommend that most people watching this channel get the advice of a good professional financial advisor to help them do that. If you've got one, great, stick with them. My only, strong recommendation is that you make sure you find one that really takes into account all the macro issues that Stephanie does. And there aren't that many out there. The universe begins to shrink to a pretty small amount when you put that requirement on. But again, if you've got a good one doing that for you, great, stick with them. If not, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple of seconds to fill out the form. These discussions are totally free, and there's no commitment to work with these guys. There's no strings attached. It's just a free public service they offer to help as many people as possible position as prudently as possible for what may lie ahead. Also, while you're there at thoughtfulmoney.com, take a second, hit the newsletter link at the top of the site to sign up for our free newsletter. And if you've been thinking about upgrading to the premium version of the newsletter, just make sure you do that quickly because the price of that is going up at the end of the month as we turn into the new year. And I want to make sure that everybody is grandfathered in at the current price. And just a reminder too, if you signed up a long time ago at the much lower price we were offering then, you don't have to worry at all. You're going to stay at that low price that you initially came in at as long as you remain a subscriber. So again, I want everybody to get grandfathered in at the lowest prices possible. All right, Steph, thanks for waiting. The viewers of this channel, as you know well, we do have a lot of professional investors, but most of them are just regular people. They're just trying to grow their wealth, primarily protect it, Definitely, hopefully not become collateral damage to a lot of the risks that you mentioned here. Maybe if there's opportunity to grow it prudently, but not by taking on too much risk. What parting bits of advice do you have for that person?
Well, I think it's the same that I gave the last time, and that is to not get swept up in the euphoria.
Mhm.
If you feel like the market's stretched, even if your neighbors are bragging about how great they're doing in X, Y, or Z, um, trust your gut, and no one's going to protect your money like you are. So, if you miss out on the next 10 or 15%, but you're protected when it goes down, you're ahead of the game. So I definitely would just be you, don't feel the pressure to participate in the latest greatest thing just because everyone else is doing it, because again, this is your hard-earned savings. And it's just way too important to let it be, possibly lost due to, getting involved with stuff that maybe you're not 100% sold on.
Very well said, Steph. And you're reminding me that I should probably do a short video on this. I believe, if I remember correctly, it's called prospect theory. This goes back to behavioral economics. The research is really clear that we as humans, we experience the severity of a loss twice as much as
Huh.
we enjoy the joy of a gain. And when you're in these kind of, run-ups, these melt-ups, these kind of manic phases of the market, we totally forget that. And then we start just obsessing over the pain of, oh, I'm missing out on this. And gosh, my idiot brother-in-law just, made
Right.
tons of money overnight, right? And we
Yeah.
get so focused on missing out, right? The whole FOMO,
Yeah.
that we totally forget that this is kind of an asymmetric decision we're making if we're deciding to get in at this late stage time. Because
Yeah.
if we end up getting in too late and then the bottom falls out, we are going to be regretting the pain of the losses we take way more than any gains that we're going to get right now. So it's, to your point, it's really important to be managing your emotions here.
Yeah. Well, it's funny you say that because I was emailing with Dave Ivan, who hosted the super terrific happy hour thing, who did a whole thing on the emerging markets and resources in general. And we were talking about the FOMO in the developed markets. And I wrote back, and I'm looking forward to FOGI, FOGI, fear of getting in
Mm.
into the emerging markets. So right now we've got FOMO in the developed world and FOG in the emerging world, and hopefully those two things will shift, and there'll be, opportunities to be had on the other side. So we'll
All
see.
right. Well, it'll be we'll be tracking that, and if and when we start seeing those shifts, Steph, open invitation to come back here on this
Thank
channel
you.
anytime in 2025 to let us know. Thank you so much, Stephanie. It's always such a privilege and such a joy. And if I don't get a chance to see you before the new year, wish you the best of holidays, you and Wilhelmina.
Well, thank you. Merry Christmas to you and yours. I hope you have a wonderful and hopefully a warmer Christmas. Oh,
Thank you. I do too. And again, people they should not shed any tears for
all
me
right.
as living in a cold climate state. All right, but
Life
thanks so much,
doesn't suck.
Steph.
Thank you.
Always, always wonderful. Everybody else, thanks so much for watching.